Okay, hope everyone's doing well. This is going to be a video over July the 12th, 2020. First off, it's a fun thing to point out. Euro dollar, it hit 1,000. So daily chart, 1,000's right here, or excuse me, 1.0000, and that hadn't happened since December of 2002, it looks like. So all the way back over here, somewhere around the close of November, open of December. So pretty interesting. Probably going to find support soon. That's a pretty big round number. Probably not going to, even look at 2,500. Spend a lot of time at 2,500 or 1.2500. Spend a lot of time right there. 1.5, a little while, but that's pretty extreme. So, probably, look at this trading range here. It's right in the middle of 1.25 and 1. So what is that? 1.1, 1.25. 1.125 is where I'm getting at. So it's probably going to go sideways over the long term. But thought that was fun to see today. 5-minute chart. Overall, we had you can call it a gap up or a buy climax that immediately reversed down, formed a triangle, and then we got a bear breakout below the triangle. On the open, the bulls had consecutive bull bars, and at this point it might have been by the close, but the problem is typically, it's a tricky situation because if you buy that close betting on the second leg, a lot of people would get out below the bear bar. And you can tell a lot of traders here, they bought this close, maybe they bought below the bar, tried to get out around 50%. And sometimes it helps to make an inverse of the chart. So let's see how easy that is to read. So all I did is I created a inverse chart, and what this is I flipped the colors of the bars or the candlesticks around. So I made the black bars that are going down, I made them white. Black bars, the bars that are supposed to be going up, I made them black. And I copy the chart. I can flip it upside down. So in other words, what I'll do is I'll just show you. So originally it looks like this. This is an exact reflection of that chart on TradeStation. And what I'll do is I'll take the chart, I will flip it like this, and then I'll drag it from the left side to the right side, and it creates an inverse of the chart. And I just actually realized y'all probably can't see it. Well, maybe y'all can. Hopefully you can. But anyways, if you didn't catch that, there's the same chart as TradeStation that I just showed on this other screen. I flip it down, I take the left side, drag it to the right side, and now I have an inverse of the Emini. And what you can see is we had a sell-off that immediately reversed up, pretty strong rally, and a trading range. You call it a triangle, tested the high close, and then an upside breakout. Another ways you can do that is you can look at the SDS, which is the inverse of the SPY, but it has a lot of gaps, so sometimes the chart can look cleaner if you make an inverse, but that takes longer. So on the open, bulls Consecutive bull bars, tail above 1, tail above 2. Might be always in long, but bulls may need one more bar. It's one of those bars where, you can take a chance, buy the close, but otherwise, most traders, you're high in the range. Most traders may want to wait for a follow-through bar. So 2 consecutive bars. Let me see if we had an example of that somewhere. Even here, tail, but we had a few bars up. Bear bar, another big bear bar, and then a weak doji bar. So that's kind of like an opposite example, but the gap down was a lot bigger. So, this might have looked a little bit different if, for one, the gap one is big, and this third bar was a bull bar closing on its high. Gap down, 2 bear bars, but again, weak doji bar, so probably sellers above, and it's sell to close. Big bear bar, but probably strong enough for always in short, but weak doji bar, so probably a second leg down. See if I can find one more example. Big gap down, 3 bear bars, bad buy signal, led to sideways to down. And, even here, big bear bar. And, it's hard to, it's realistically, I think a lot of traders would get out of shorts above that second bull bar. But anyways, kind of the same example. So if bulls did buy, they probably get out below that third bear bar. I'll do it like this. I forgot to point out, here's the open of the week, which you can see the market raced up to. So I'll keep that on there. So consecutive bull bars, bear bar, always in bulls probably get out. Okay, short below, but probably buyers below and at least second leg up. And then there's a give up bar. At this point, probably always in short, probably going down for at least a second leg. So it is probably sell to close. That's a tricky trade though, because if you get a bull bar, a lot of traders may try and get out break even. So traders will sell more higher, try to get out break even. And it didn't trigger. More down, so now we have 5 bar micro channel. And again, it's probably sell to close. 6 bar micro channel, still sell to close. Strong enough bear breakout. You always have to wonder if we ultimately get a test of the high of the day to the open of the day. I just want to see if we got it. I know we did, but I want to just see where. Yeah, kind of that bar right there. Okay. So big bear bar. Chart a little smaller. Sell to close, but getting to be difficult. Probably sell to close, but again, tail below. So, again, probably a second leg down, but might find buyers somewhere down here. Most bulls probably they'd look for a second entry buy, like a micro double bottom. Bull bar closing below its midpoint, bad reversal bar, probably sellers above. Probably will fill this gap though, so buyers will buy here, scaling lower, get out somewhere over here. And that's a problem for the bears. Bulls were able to buy. We went above this bar rather quickly. Bulls made money buying above the bar. That's a sign of trading range price action, kind of like over here. So a little bit lower, reversed up, and bulls that bought this close, bought anywhere up here, quickly made money. So a sign of trading range price action. 3 bull bars, but again, probably minor after this sell-off. Second entry short, or you can call it a low 1. It's a low 2 on a smaller time frame, maybe even a wedge, but we'll call it a low 1. Big bar, big risk, probably buyers below. Weak bar right here, and you can see if the bulls were able to get out break even up here. They bought this close, disappointed with this bear bar, got out break even. When that happens, that's a sign that the bears are not that strong. The bulls aren't trapped. And if the bulls aren't trapped, then there's not traders that'll push the market down. Like right here, The bulls that bought this close got trapped on these two bars, so any sort of bounce, they'll give up. And look what happened on the open of this bar. The tail was 62.75, the high was 3. So we had a one tick tail and a very big body. So bears quickly sold and bulls quickly gave up. Big bull bar. So breaking out above this, you can call it a bear flag. Again, I said probably buyers below here. Bears that sold this bar, they probably want a quick breakout. And it's similar to this. They sell this close. They want the market to move quickly in their way, like it did here. And if it hesitates, they may get out. We had a few instances like that right here, where big bull bar, this bar raced up, and then it began to sell off. And when that happens, a lot of traders will just sell out of the longs and look to buy later. Same thing here. Big bull bar and closed at its midpoint. And then we got a bear bar. And then we went outside up. So let me go back to where we were. So big bull bar, but again, probably minor reversal up. Bulls need consecutive bull bars. And, this is a problem for the bulls. You also have bulls up here that'll buy more lower. They're going to get out on any sort of bounce at break even. So you can call it a wedge bottom, but this is probably strong enough bull bar, probably buyers below, and you can see the bulls bought this close, scaled in, got out break even. Second entry buy, trying to break out above the wedge, but again, now we have a more complex wedge top. And then we broke to the upside, weak follow through, and got you can call it a low 4. It's consecutive tops. So top 1, 2, 3, there's a wedge, bull breakout, second leg up, second entry short. It's testing the breakout point of, it's testing the stop entry short. So here, it tested it, went above it, turned down. A lot of traders would get out below that bar. Even though it doesn't look ideal, it's still a complex top and high in the range. And this looks like a leg in a trading range. So bear bar, tail, consecutive bear bars. Is it sell to close? Maybe, but bears probably need one more bar. Some bears will sell, scale in higher, betting on at least a small second leg down. Weak bear bar, so some traders will try and sell above the bar. Other traders may just try and sell the close, scalp out, which you can see they did. Traders sold this close, got out at this low, which caused the reversal up. The bulls knew that, so the bulls would buy this low, betting on a micro double bottom. Tight trading range though, so traders buying here, it's not ideal. It's also a micro channel, increases the odds that the bears get a second leg down. So buying here is not the easiest thing in the world. Doji bar, if a bull did buy here, it's the same thing over here. Trading range days, a lot of times traders will be quick to get out or use a wide stop. So if you're buying here, you're hoping for a test up to here, a test up to here. You want a fast move. Like here, if you're selling below this bar or selling the close, you want price to go up a little bit, and then you want those bulls that bought here to give up and the market quickly go down. That is not bears quickly giving up. That is confusion. That is bulls hesitating to buy above the bar. And then went outside down. And the problem with trading ranges is it didn't really happen there, but a lot of times you'll get the market will go below this low and turn up. So again, not ideal stop entry, here. Tight trading range. Bulls are buying below weak bear flags or weak looking low 1s, low 2. Guess what? Bulls are probably going to buy below it. It doesn't look that strong. And it went outside up. Second bull bar, third bull bar, trying to break to the upside. A fourth bull bar, 4-bar micro channel. Is it strong enough for a second leg? Probably. It's a bull breakout above this bear flag. But you're getting up in the sell zone up here, so it's not ideal. And a trader buying this close, buying down here. Most maybe you can buy the low of the bar, but it's pretty aggressive. And again, there was the exit. So a lot of traders, they buy this low and they quickly scalp out for a small scalp. give up bar, but closed at its midpoint. And for some of the bears, they'll use this sell-off to take profit. So some bears, maybe they sold down here, and maybe they sold more just anywhere up here. And you can see, even if they sold below that doji, they could have gotten out break even. That's not an ideal thing to do. I lost my place. There we are. Not an ideal thing to do, but some traders will do it. So middle of a tight trading range, you can call it a triangle. Here's the bottom. Here's the top. Probability favors, it's 50-50. Second entry buy, maybe we'll get a new high, maybe we'll test up here. But this is, that's pretty disappointing for the bulls. Outside down, so more confusion. It's a limit order market. Most traders should wait for the breakout. 3 consecutive bear bars, probably sellers above and a second leg down, but trying to test the bottom here, make it a double bottom, make it a double bottom down here, maybe down here. But even if you get a sell off that quick, that's going to be strong enough where you may go a little bit lower. So it's difficult to do anything. It's limit order market. Traders are doing the opposite of stop orders. Bulls, they're buying but getting out quickly. The bears are selling above new highs. Third consecutive bear bar, fourth, probably sellers above and at least second leg down. The problem here though is best looking bear bar in the micro channel at the bottom of the range. So traders have to be quick to make decisions. Doji bar, a sign, and now it's a 5 bar micro channel. Don't really have any gaps. Maybe you have a gap here below this bar, high of this bar. So you can call it a micro gap. That's a sign though that the market may find buyers soon, and you broke below this low. So a lot of traders be quick to just get out. Too much risk of a reversal up and not really an ideal sell to close situation. This is a sell to close situation, or this. This is a buy the close situation. This isn't ideal. And you can see traders that they didn't sell that close, and even traders that sold this high and scaled in hesitated. They were quick to get out around break even on their first entry, and it led to a second leg. A lot of bulls would see this as a weak low one. They would buy it, betting on a second leg. Bull breakout, but it's a wedge, 1, 2, 3, and then we got a bear bar. Might get a second leg down after those 5 consecutive bear bars. Might get a second leg down, test this close. Give up bar, weak reversal bar, probably at least second leg down. We're testing the low close here, but even if we rally a little bit, I still think we'll get a second leg down. So not an ideal stop entry buy above. Second leg down, micro double bottom. You can call it a second entry buy, but you have to ask yourself, why did that bar close at its midpoint? Tight trading range here below the moving average. That's a problem. And then we got a give up bar. So is this exhaustion or give up bar? And I know I just said a give up bar, but it's a give up bar. And you have to look at how many bars it's closing below. I measured it earlier. I think it closed below 42 bars. So 42 bars from this close all the way over here are now above this close. That's a strong bar. It's a surprise, and it's probably not exhaustion. And surprises lead to second legs. So traders will sell this close and bet on a second leg down. Now what happens if we get a bull bar closing all the way up here? Well, then that'll be a different story, and you'll have bears that are trapped, just like you had bulls that bought here. They got trapped on this reversal down. It'd be the exact opposite situation. So more importantly, a lot of bulls will get out at this close, and the reason why is they know there's a second leg that's likely, and the problem is they don't know how far the second leg could go down. The second leg could be something like this, second leg, or a better example is this, breakout, second leg, Or the second leg could be breakout and a big second leg. So the problem is stop placement. Even if you put your stop down here, that could be a problem. And we got a bull bar, but again, it wasn't a strong enough bar to erase this. So it could just be a breakout to the downside, a pullback, and then a sell-off, which would be a breakout pullback below one, short below this bar. So trying to pull back, you call it a micro double bottom, down, up. But again, it's a micro channel, 3 bars. Let's see what happens. And boom, bear bar. So what happened there? Well, the bulls sold off, tried to reverse the market, sold off, tried to reverse the market again. It's a small double top, and we're breaking below the neckline of the double top, and we got a bear bar, and then we got another bear bar. So if you notice, again, I mentioned this over here. We had bulls that were hoping for a bounce so they could get out with a smaller loss. They tried here. They let the market reverse up twice. They're not going to let the market, in other words, they let the market reverse down once and then it turned up for a second time. They're not going to let the market reverse down a second time below this bar, which would create a double top or a micro double top. They're not going to let that happen. And then you got a bear bar closing on its low. You have a measuring gap, and you don't know where the bottom of where the measured move is going to be. It could be here. It could be there. I mean, it could just go a little bit lower. It could be, it's all sorts of places. But even if it's here, one's a lot better off getting out and looking to buy later. And the tail on this, and this tells me this was a give up bar because look at the tail of this bar. Up 1 tick, maybe 2, and immediately turned down. So sell the close, always in short, and we're testing the day's low. We also tested the low close right here and broke strongly below it. So now we're testing the low of the day to the tick. And the odds are you're going to get a second leg down. Again, it's the same situation here. If the bulls get a strong bull bar closing up here, will traders buy? Sure they will. But we don't have that right now. So we have no idea. We could get a bull bar looking like this, so the opposite of that. We could get a weak bar that leads to a second leg and then reverses. Or we could get a big bear bar like that. And you got a huge bear bar. So it's a vacuum test of support, selling down here, but after 3 consecutive bear bars, that's a really strong bar, breaking below a trading range. Breaking below a trading range. Probably going at least a little bit lower, and again, it's sell to close. And when it's sell to close, a lot of traders want a micro double bottom because the odds favor a second leg. And if the odds favor a second leg down, then it doesn't make sense to buy when there's a high probability of a second leg. The difference is you don't know how far the second leg will go. It might go a couple bars down and reverse up, and you can buy later. So the whole point is, if traders expect a second leg, then they're not going to be that thrilled to sell. Like here, the odds favored a second leg down after these 2 bear bars. And this bounce was more or less a scalp. Bulls buying these lows, buying this close, scaling in lower, getting out break even. But the bears that sold this close and sold more higher, they're disappointed here. So guess what they did? They got out at the low close. So one thing to point out, I forgot to mention, was this satisfied the test of this low close. Bears sold, disappointed, they could get out break even. So there wasn't a need to necessarily there wasn't a lot of bears. Personally, I don't think there were a lot of bears trapped right here, desperate to get out. Most of them were able to get out, which increased the chances if we got a test down to here that we could get, a bigger breakout than we think. So another bear bar, bull bar, but again, after this many bear bars, first slope is probably minor. This is more profit taking than probably anything else. And you can see bears sold this close, scaled in higher, and they were willing to give up a few ticks to get out at the low close. But even there, this move was so strong that the bulls that bought this close, disappointed here, they wanted to see follow through quickly. What did they do up here? They gave up. So it's the same thing. It's a micro double top. Market went down and up, and then went down and up, and it's turning back down again. Or you can say it went up, down, up again, turning down again. Doji bar, but again, tight channel, probably too early to buy. It's hard for bulls to make money. And we're just selling off. So at this point, most traders would give up. It's kind of a wedge, 1, 2, 3. Probably going to rally at least for a few bars. And we rallied back into the close and back in this area. So always in. If you buy this close, probably get out below this bar or below here. Not an ideal buy the close with this tail. The bulls probably needed one more bar. And if they probably need one more bar, you'll have bears who will sell the close, betting that the bulls won't get one more bar, and they'll get out if the bulls do get another bar. So bulls probably get out below this bar. Aggressive bears sell. They sell below here. They sell above bars. They sell this close. They can sell this close, but again, you probably need to be able to scale in if you're selling down here. Too much risk, the market's going to reverse. So if one couldn't scale it, probably better off looking to sell higher, so they have time to be able to make a decision. If you sold up here, you have time to get out for at least a small profit. Big bull bar, always in long. I don't know. I think a lot of traders always in. The problem is when you have a trading range, I think a lot of traders would look to get out over here. And certainly as this bar is turning up, there's just too much risk that the market's going to go higher. And if the market's not going to go that much lower, then it's better to be selling with limit orders and not holding short. Let me get some water. Voice is getting a little dry. So aggressive bulls, they can buy. Probably no reason to sell yet. No reason to sell. Upside breakout. Again, it might be always in long, but it's a leg in a trading range. So most traders are scalping. I think bulls probably get out below this bar. Is it always in short? Maybe, in the sense that we'll get a second leg, but if you sell here, you probably have to get out above this bar. So most traders that are selling for a quick move and being quick to get out. And then again, bulls probably get out. Aggressive bulls buy, bears get out. 4-bar rally, probably not sell the close yet here. Bulls can get out up here, betting on a double top or a triangle. Outside down bar, a lot of bulls probably get out on this bar. You had an attempt to break out above this triangle right here. During this bar, it turned down. So bulls probably get out here. Tight channel, first reversal up's probably going to fail. Bulls can buy for the micro double bottom, but again, tight enough rally that it's not ideal. So if a bull is buying here and they see this disappointing follow through, they're probably going to be quick to get out, which they obviously were. And bulls probably get out below this bar. Aggressive bears can sell, or they can sell this close, betting on a second leg. And do they get out above that bar? They can. It obviously didn't trigger. And surprise bar. So again, back to always in short. And if you did sell, you don't get out above that bar. That bar, you don't get out above that. And maybe you get out above that, but it never triggered. And if you were truly trading always in, you would trail your stop. You wouldn't get out there because it didn't trigger. And you get out for a pretty big profit down here. And some always in bulls will buy, betting on a quick reversal up here. One thing I would say that's important to understand is understand where limit order traders get trapped, because that is where breakouts occur. So what do I mean by that? Well, limit order trading is the exact opposite of stop order trading. Stop order trading, you're betting on a breakout. And a breakout can be 1 bar. It can be, a breakout above this bar. That's a breakout. Breakout of what? This bar, this high, breakout back to the open of the week. You can say, sorry I had to pause the video for a minute, but yeah, one thing I wanted to say about limit orders and breakouts are it's important to, a scalp or limit order trade is the opposite of a breakout. It's betting on regression to the mean if you want the mathematics of it, and the mean of something would be, and the trading range mean would be the middle. So a limit order is betting on regression back to the middle. So selling this high is fading a breakout, which is a limit order trade. Buying this low is betting on a failed breakout. And limit order trades work well until you get a breakout. And it's really important to understand when the market transitions from a breakout, such as sell the close or buy the close, because that's where limit order traders get out. And the easiest example is here. Bulls that were buying these lows, big bear bar, the bulls are trapped. So what are they going to do? Well, they're going to use any bounce to get out break even. And they have to have a means to be quick to get out. So if a bull is buying this low and they don't get stopped out on this bar, what do? Well, they have to get out below that bar. They can't just hold all the way down. A bull that bought this close and they scaled in lower, regardless of what they did, they've got to have a means to get out, either during this bar as it's turning down or something. And if you're looking to, an easy way to think through that is look for buy the close, sell the close situations. So, for example, if it's sell the close here, traders will scale in higher, they're going to be disappointed, which means they're going to be wanting to get out back at their low close. That's a limit order area. That means if you know that bears are looking to get out back at their original entry or the low close, then gives someone a higher confidence and higher probability that this is going to fail, especially when you see this and the market reverses up. Here, same thing. While this looks like a great short, after this big bull bar, even the bears that sold this close and sold more here, they're going to be disappointed. So they're going to want to get out around their midpoint, which is somewhere down here. Same thing up here. Bulls, maybe they buy this close, they scale in. Well, what are they going to do up here? It went a little bit lower, but reversed down. The point is, if there's a clear sell the close or buy the close, it increases the chances of more trending price action. So, strong breakout. Most traders won't sell here because it's buy the close, which means the first reversal down will fail. And if the first reversal down will fail, then you're going to get a second leg. And if you're going to get a second leg, you don't know how far the second leg could go. So it could be a little bit higher and then sell off, or it could be a big second leg like this. Anyways, I'll talk more on that. Someone asked me about a break. They asked me to, and I'll wrap this video up in just a second, but someone asked about break-even stops. How Al says in one of the videos, video 36A, that break-even stops are mathematically stupid, and there's no mathematical basis for using a break-even stop, and that's true. And the problem with a break-even stop is it ignores the, I'll do another video down the road here soon about, I'll use a spreadsheet and go over just kind of basic probabilities. But the problem with the break-even stop is it ignores probabilities. And here, I'll do a spreadsheet real quick. This is how I do it all the time. Just a really easy scenario. So probability of success, here's my reward. So here's my probability, reward, failure, percent, and risk. So I'll do it like this. So I did 1 minus that, so it equals 100, 60%, 40%, 100. And I'll do this. So let's say I'm risking, that should work. And this is going to be TE for trader's equation. So probability of success times the reward minus the probability of failure times the risk. I'm going to do more of a number because I like that more. So what this is risking 1-to-1. And I show this example all the time. Here's a 40% scenario where your reward is 2 and your risk is 1. And so here's 40%, here is a 60% trade. And the 60% trade is a 1-to-1, so I'm risking $100 to make 100, or I'm risking $1 to make $1. And here is a 40% example where I'm risking $1 to make $2, or I'm risking $100 to make $200. And at the end of the day, the outcome is the same. So if I take 10 trades, this gives you a 0.2. Now I could do $100 and do $100 like that, or I could do $200 and $100. And the problem is that, and I could go into many things about this, but this is the basics of the trader's equation. And if I factor in, if you're trading Emini and your risk and your commission is $5, then your reward is $95 and your risk is $105. So you just lost 20%. You went from 20 to 15 when you factor in commission. Here, your risk is $105 and your reward's $195. So you went to 15. So what you thought was 20 is really 15. But anyways, we'll ignore commission for a second. The problem with the break-even stop is it ignores the trader's equation. So let's look at an example. Let's just say, hypothetically, I'm trying to think of an example. I'm going to make up one. Okay, let's just do, I like this one because this one's easy. I'm going to buy this close of the prior day, which would have been the 11th. I'm going to buy this close, put my stop down here, and I'm going to take part off at twice my actual risk, or some sort of, maybe I'll take part off a half the distance to a measured move up. So somewhere like high of this bar. So I'm going to trade 2 contracts or 2 lots. I'm going to take one lot off here, and then I'm going to move my other lot to break even, which is here. And you can do that. A lot of people do that and they set a runner, but it's way more effective to use price action and factor in the trader's equation. So if I buy here, my risk was here. This is several times my risk. I get a bear bar, tight channel, maybe you get a second bear bar. Now I have 2 consecutive bear bars, top of the range. It makes more sense to get out because what's the probability price goes from this low to this close? I mean, it's probably greater than 50-50. And that's not ideal math to be long, and therefore you don't want to give up profit. And that really just gets into other people's money. Al has a video, I think it's managing when a trade goes bad. I can't remember, but other people's money doesn't exist. And I know people like to think it does. I firmly disagree that it, the logic that I can, I'll use we'll just use the euro dollar. I mean, if I bought the euro in 2015 and price went all the way up to here and then all the way back down to here, and I'm back to break even, am I really going to say oh, that was just someone else's money, I didn't really lose it. No. If you go to a casino and you make $1,000 and then you lose it on the very next bet, you still lost $1,000. I mean, just because it was someone else's money that you lost, it was still in your account. That's the whole thing of, if you bought the low of the day and price was all the way up here, this is not open profit. This is your risk. So if your stop's all the way down here, your risk is the low to this close. That's the problem with break-even stops, is it ignores the math. If I'm buying this close, the odds are really, really high that I'm going to get a second leg up. Now, here's a second leg, here's another leg, here's another leg. So by this close, the odds are beginning to shift that we're going to go to the downside. I mean, imagine if I bought this close, I got a great fill, and price is all the way up here, and I have a huge open profit. Does it make, how would you really feel if you stopped out all the way down here and gave up 60, 70, 80, over 20 points? It doesn't make any sense, and especially if it's clearly going lower, it makes more sense to sell. So that's the problem with break-even stops. Now, people use them, to Al's point, and he says this in the video, people use them all the time. And they use it in the sense of, it gives them less to think about. It's very important when you have to figure out how to lessen your decisions. So if I can, most traders don't want to lose. So if they buy this close, price goes up to here, they're probably just going to put their stop at break even or close to it, because they realistically, if they don't want the market to just, it could happen where you get a just quick sell off and stop you out. They don't want to lose money on the trade, since they've especially already probably taken partial profits, and it eases decisions. Most traders, though, are probably just going to put it below a bar, maybe below this bar, and trail, and then you get a breakout, move it here, and then you get this bar, and then you stop out at the end of the day. So if, same thing with, let's find a day that reversed, okay? You're going to sell this close, big bear bar, odds are you're going to get a second leg. Most traders are going to get out here, or this close, or on a pullback, because the odds are you're going to get a deep pullback. So if you sold during this bar, it doesn't make sense to give up this open profit, because it's risk. And the other problem with it is this right here. Let's say I'm getting 1-to-1 on, I sell this close, stop up here, I get 1 times my risk. Okay, well, if I'm risking $100, well, what if I am breaking even on half and only making half? So I'm making $50 instead of $100. Well, if I do that enough times, my break even, if I'm right 60% of the time, then, and this math still isn't exactly right, but it makes the math more difficult, and it could take a really long time to explain that. But what I would just say to this person that asked the question is, people use break-even stops just for quick decisions. Market's moving fast. They sell this close, maybe they sell more higher. Market quickly starts racing down. They're just going to move it to break even just because it's an easy, doesn't take a lot of thought, and then they can focus on what's in front of them. Now, there's better ways to manage that, and again, it's just others will just, market starts to go down, they'll just drag their stop somewhere up here. A lot of times, if you sell this close, I know Al says put a stop up here. Most traders aren't going to put a stop up here. They're just going to move it somewhere in this area. And if the market starts to reverse and it looks weak, they may, some will be flexible and sell more. Others will, just get out on consecutive bull bars like that. So it's really preference. So I hope that example helps.